Okay, let's unpack this. Have you ever wondered how retailers, manage to keep up with this? One minute we're glued to our phones, buying something with a single tap.
Yeah, and the next we're back wandering through actual stores.
Exactly. And our mood, it just swings between treat myself and got to save cash.
It really does. And the headlines are all over the place, too. Physical stores are doomed. No, wait, e-commerce growth is slowing. It's dizzying.
It is. It's a total whirlwind. So today, we're diving deep into that complexity specifically, the U.S. retail sector.
Yeah, it really feels like the ground is constantly shifting under retailers' feet. You've got this incredible acceleration of online shopping, but then physical stores show this surprising resilience and consumer confidence. It's like a seesaw, pulled by a strong economy one way,
Right.
but then held back by these nagging worries about prices, maybe external shocks, things like that.
Exactly. And for anyone watching this space, maybe you're tracking it through something like a retail sector ETF. Well, understanding these dynamics is just essential.
Absolutely critical.
So our mission for this deep dive is really to cut through all that noise. We've pulled together a stack of recent analyses, outlooks from giants like Deloitte, McKinsey, MarketSource, the Richmond Fed, NRF.
A lot of heavy hitters there.
Yeah. And we're going to trade and extract the most important nuggets, the key insights, to give you a clearer picture of, the current state and where things might be heading, where and how consumers are spending their money.
Sounds like a plan. We can start by setting the stage, maybe with the big picture economy, then dig into how consumers are actually feeling, adjusting their budgets.
Okay.
And then maybe explore that evolving battleground, online versus physical retail, look at the tech powering it all, and maybe touch on some key emerging trends, like that whole buy now, pay later thing.
Yeah, definitely need to cover that. Sounds like a comprehensive roadmap. So let's start right there with that fundamental layer, the macroeconomic environment. Deloitte's outlook, you mentioned, gives a baseline for 2025. What's the general economic forecast they're working with?
Well, Deloitte's baseline scenario for 2025 is actually quite positive. They're anticipating a generally strong economy,
Okay.
which should provide a pretty solid foundation for retail sales growth. Their view basically is that unless there are any, significant unforeseen shocks,
Right.
the U.S. economy is positioned to continue its, relatively strong post-pandemic recovery, especially compared to a lot of other advanced economies.
And what specific factors within that picture do they see as directly benefiting consumers and then, by extension, retail?
There are a few key tailwinds they point to. Probably the most significant one is the easing of inflation.
Okay, that's huge.
It really is. Deloitte points to the Personal Consumption Expenditure Price Index, the PCE figure. That's the one the Fed prefers, because it captures a broader range of spending and adjusts for how people substitute cheaper goods when prices rise.
Right, the PCE, yeah.
Exactly. And that figure dropped dramatically. It hit 2.3% in October 2024. Now, you compare that to its peak, which was, 7.2% back in June 2022.
Wow, that's a massive difference.
Huge reduction in price pressure.
And low inflation means consumers' money stretches further, right? Does that translate into real wage gains in their analysis?
It does, yeah. When inflation falls faster than wages, your purchasing power goes up. So real average hourly earnings, that's your pay adjusted for inflation, they grew by 1.2% in the year leading up to November 2024.
Okay.
Which is better than the 0.8% growth they saw in the same period in 2023. And importantly, nominal wage growth, just the dollar amount of your pay that's still above pre-pandemic levels. So yeah, people are earning more and those earnings are losing less value to inflation.
Okay, so improved purchasing power, that's one factor. What about job security? How's the labor market looking in their view?
The labor market remains healthy, which is, absolutely crucial for consumer confidence and spending.
Sure.
We've seen steady non-farm payroll growth, averaging over 180,000 new jobs per month in the first 11 months of 2024.
Pretty solid.
Yeah, and key indicators like job openings, layoff rates, quit rates, they've sort of stabilized, sitting pretty close to their pre-pandemic levels. Unemployment rate is low, 4.2%. Labor force participation is also near pre-pandemic levels, about 62.5%.
So basically, people who want jobs can mostly find them.
That's the picture. The job market isn't showing signs of significant stress, which gives consumers confidence.
Right. And what about borrowing costs? Because that high interest rate environment, that's been a challenge for a lot of people.
That's the third piece Deloitte highlights. They anticipate the Fed will start to ease monetary policy, Their forecast suggests the federal funds rate, the target rate influencing borrowing costs, could be cut, maybe down to a range of 3.75% to 4% by the end of 2025.
Okay, some relief potentially.
Potentially. Now, the impact on long-term rates like mortgages might be less pronounced because those are influenced by other things like treasury yields.
Sure.
But lower policy rates should lead to reduced interest costs for things like variable rate credit cards. That could offer some breathing room for consumers carrying balances.
So, okay, easing inflation, a robust job market, potentially lower borrowing costs. How does Deloitte see all this translating into actual consumer spending for 2025?
In this baseline scenario, they're forecasting solid growth, about 3.1% in overall consumer spending for 2025. And one particularly interesting point is the expected strength in durable goods spending.
Ah, the big ticket items.
Exactly. Things meant to last, appliances, furniture, maybe cars. Deloitte projects a healthy 4.7% growth there in 2025.
That does suggest confidence, doesn't it? Making those bigger purchases.
It really does. It suggests consumers feel confident enough about their finances and, the future to commit to those longer-term purchases. That's a strong signal for certain parts of the retail sector.
Okay, that's the optimistic picture. Does Deloitte outline a potential downside? Like what could derail this positive outlook?
They do, yeah, though they assign a lower probability to it. The primary risk they flag is a sharp escalation in trade tensions, specifically a significant hike in tariffs.
Ah, tariffs. Okay.
Yeah. For example, they modeled a scenario with like a 60% tariff on goods from China and 20% on goods from all other trading partners.
Whoa.
Yeah. In that scenario, such a shock could trigger a broader economic slowdown. It might even force the Fed to increase rates in 2026 to fight the resulting inflation.
Oh, the opposite direction.
Right. Which could lead to a contraction in consumer spending and GDP, and that obviously would significantly dent retail sales.
Wow. It just underscores how interconnected everything is, the global economy, trade policy, consumer wallets.
Absolutely.
Okay, so we have this macro picture, mostly positive, but with clear risks hanging over it. Now let's zoom in. How are consumers actually feeling and behaving against this backdrop? McKinsey's reports from February and May 2025, you said they offer some fascinating insights into sentiment. What did they find early in 2025?
Yeah, in the first quarter of 2025, sentiment was notably optimistic. A plurality, 46% of consumers they surveyed expressed optimism about the economy.
Okay, nearly half.
And that optimism was largely linked to those positive indicators we just talked about. Low unemployment, job growth, inflation that, at that moment, felt more stable than it had.
Okay, optimism's good, but was that translating into consumers just, like, throwing caution to the wind and spending freely?
Not quite. And that's the interesting nuance. Despite the optimism, caution around spending actually persisted. Consumer spending intentions across several discretionary categories were actually down compared to the end of 2024. It seems like they weren't carrying over that holiday season splurge into the new year. They sort of reverted to a more typical, maybe more restrained post-holiday spending pattern.
So, feeling good about the big picture, but still a bit hesitant about opening their wallets too wide for non-essentials. What was their main worry then?
Rising prices, still the top worry, by a significant margin. In that Q1 survey, half of all consumers cited rising prices as their biggest concern.
Half.
Yeah, and this worry was particularly pronounced among older demographics. So even with overall inflation easing, that cumulative effect of past price increases still weighing on people's minds, especially for everyday stuff.
That makes total sense. I mean, the cost of groceries, other essentials, it's still way up compared to a few years ago.
Okay, then the May survey came out, and this was after the news about potential new tariffs started swirling. How did that impact sentiment?
This is where you see a really notable shift. That news about potential tariffs, it had a clear chilling effect. Net sentiment, optimism minus pessimism dropped significantly in May, fell to 32%.
Down 9 points.
Yeah, a 9 percentage point decrease from Q1. And while rising prices were still the #1 concern for 43% in May, tariffs rapidly climbed up the list, became the second biggest worry, cited by 29%.
And how aware were people of this tariff talk? Was it just background noise?
No, not at all. They were extremely aware. McKinsey's May survey found that 91% of consumers had either heard news about tariffs or actually discussed the topic with others.
91%. Yeah, it wasn't some abstract policy debate for them. It was something they were actively processing, feeling like it could really impact their own lives.
That high level of awareness is really striking.
Yeah.
It means consumers were reacting in anticipation of price hikes, right? Before any tariffs were actually implemented or felt in stores.
Exactly. That's a key insight.
So how are they planning to adjust their spending habits, given this renewed caution, especially tied to the tariff news?
Well, most consumers surveyed in May said they had already changed their spending habits, or they expected to change them soon, specifically because of the potential tariff impacts.
Wow, that proactive adjustment.
It really shows how sensitive consumers are to economic uncertainty. They weren't waiting.
Were these planned adjustments consistent across different age groups? Or did you see variations?
No, not entirely consistent. And this really highlights that fragmented consumer picture retailers are dealing with, Gen Z and millennials. They were notably more likely to report expecting to change their spending habits in response to the news. Baby boomers, on the other hand, seemed more resistant to making new adjustments.
Interesting. Why do you think that is?
Well, one possible explanation is that boomers might have already been spending more cautiously overall compared to younger generations, so maybe there was just less room for them to cut back further.
That's a great point. If you're already focused on value, new pressures might not change your behavior as much. So what specific actions were consumers taking or planning to take?
The most common behavior was what's often called trading down. This was really widespread. 3/4 of consumers reported trading down in Q1 2025.
3/4. And what does trading down look like in practice?
It involves different strategies, cutting back on non-essential items altogether, just buying fewer things overall, or switching to lower-priced brands or private label products within certain categories.
Can you give us a concrete example of that?
Yeah, the grocery category is a really clear one, probably driven by those sustained high food costs.
Yes.
Low-income households, for instance, particularly increased their trading down on meat and dairy. 51% reported doing this in Q1 2025, and that was up from 40% just the previous quarter.
Significant jump.
Yeah. But it wasn't just lower-income consumers. Even high-income households were making more economical choices in areas like packaged foods, opting for cheaper brands, private labels, more often than they had just a few months earlier. It really shows that this value-seeking thing, it's a broad trend, not just confined to one income bracket.
That really reinforces the idea that value means different things, but almost everyone is thinking about it. You mentioned generational differences in adjusting spending. Were there differences in how they were trading down or shifting purchases?
Yes, there were. As we noted, boomers were most likely to focus on just cutting non-essential spending altogether.
Okay.
Gen Z showed a different inclination in some areas. For example, they were 7 percentage points more likely than the average consumer to say they'd purchase items secondhand in response to the tariff news.
Ah, the secondhand market.
Yeah. Now, this could be partly driven by cost, especially for bigger items like cars, but it probably also reflects a greater openness, maybe acceptance of the secondhand market generally, even for things like clothes.
That diverse response across generations. It must be such a challenge for retailers trying to message everyone effectively.
Absolutely.
What about spending intentions across different retail categories? Were some expected to fare better or worse based on this caution?
Yeah, consumers definitely expected to delay purchases in a lot of discretionary categories. Around half said they'd put off buying things like electronics, accessories, jewelry, or choosing to dine out less often.
Okay, the nice-to-haves.
Pretty much. Spending on core essentials, though, groceries, vitamins, gas, that was expected to remain unchanged for about 40% of consumers. Foundational needs hold steady.
But were there any interesting bright spots? Categories where spending intent was actually increasing, despite the overall caution.
Yes, and this is where the nuances really come in. Despite those planned cuts in areas like apparel, footwear, electronics, consumers specifically plan to increase their spending on cruises and international flights compared to the previous quarter.
Travel again.
Travel again. It aligns with seasonal planning, sure, but it suggests that for some, experiences in travel remain a real priority, even if they're cutting back on physical goods.
Interesting trade-off.
Also, home improvement and gardening supplies saw expected increases, likely just people gearing up for spring.
So it's more of a rebalancing act, not a complete shutdown of spending. They're shifting budgets based on priorities, seasonality. What about splurging? Was that still happening at all?
Well, overall intentions to splurge were less common compared to, say, the ramp up to the 2024 holidays.
Okay.
And again, it varied a lot by demographic. Fewer baby boomers planned to splurge, only about 20% in Q1 2025. Millennials, though, much more likely. Over half intended to splurge. And among high-income millennials, a significant 63% planned splurges.
And what were they splurging on?
Particularly travel and jewelry for that group.
Travel just keeps coming up as a splurge category, doesn't it? Across different age groups.
It really does. Gen X and boomers also reported increased intentions to splurge on travel. It seems to be one area where consumers are still willing to spend, even when being more cautious elsewhere. There was also an interesting observation about food-related splurging. While dining out and groceries were still categories where consumers planned to splurge most often among food options, fewer intended to do so compared to the previous year.
Why is that?
McKinsey suggested this might be because with food prices staying so persistently high, just allocating a larger chunk of your budget to groceries or restaurant meals, well, it feels less like a splurge now
Right.
and more like just the new elevated baseline cost of living.
That's a powerful insight. The cost of essentials has risen so much, it's actually redefined what feels like discretionary spending.
Wow. Okay, so how on earth do retailers navigate this incredibly complex landscape? You've got consumers who are price sensitive, but also value experience, optimistic big picture, but worried about their own budget, and whose behavior varies so much by age and income.
Yeah, it's tough. And this brings us right back to Deloitte's point about the absolute necessity of engaging the value-seeking consumer.
Right.
Retailers have to understand that value today is this multi-dimensional concept. It's not just the lowest price tag anymore.
So what else is it?
Well, for some, value means high quality. For others, it's about a seamless experience or convenience, or even how the brand aligns with their personal values. And crucially, what value means is different for every single consumer segment.
How are retailers trying to meet these diverse needs then? What strategies are they using?
Personalization is seen as absolutely critical. Deloitte's survey found nearly half of retail executives see strengthening their loyalty programs as a top growth opportunity. Okay, loyalty programs.
Yeah.
But how are they strengthening them?
They're not just offering points anymore. They're investing in personalizing the program structure itself, adding tiers, exploring co-branded offers, trying to make these interactions more profitable for the retailer while offering really tailored benefits to the customer.
Beyond loyalty, what other strategies are proving important?
Creating engaging experiences is also key, cited by 4 in 10 executives. And this is where technology, especially AI and machine learning, is making a big difference.
How so?
Retailers are using AI for really precise targeting in their marketing, curating personalized ad experiences. Deloitte gave the example of a denim retailer using an interactive online questionnaire powered by AI to act as a personalized jeans fit guide, helping customers find the perfect size and style without even trying anything on.
That's pretty cool.
Yeah. And in physical stores, retailers are experimenting with interactive displays, digital signage that can offer personalized recommendations based on, a shopper's profile or their behavior in the store.
So, tech is enhancing both the digital and the physical experience. Convenience was a huge driver for e-commerce, we know that. Is that still a major focus across the board?
Oh, absolutely. Convenience remains a top priority for nearly half of executives looking to entice consumers. This involves improving logistics, things like last-mile delivery options.
Getting stuff to people faster.
Exactly, and ensuring accurate, real-time inventory visibility, so shoppers know if an item is actually in stock online or at their local store before they bother going.
That inventory visibility is huge. So frustrating when it's wrong.
Isn't it? And generative AI is also seen as a way to create consumer efficiencies. Things like AI-powered product recommendations, price comparisons. 7 in 10 executives expect to see increased use of these tools within the year.
And despite all this talk of value beyond price, are traditional discounts and promotions still a major lever retailers are pulling?
Yes, definitely. Perhaps more than ever, actually. 8 in 10 executives anticipate an escalation of price wars in the coming year.
Wow, price wars.
But even here, AI is playing a role. 3/4 of executives expect AI to assist with dynamic pricing strategies. Meaning they can adjust prices in real time based on demand, competitor pricing, inventory levels. It's much more sophisticated than just blanket discounts.
It sounds like technology, especially AI, is just absolutely central to delivering this kind of personalized, efficient value proposition. What are the biggest roadblocks retailers face in actually implementing these sophisticated strategies?
Well, the fragmented consumer base itself is obviously challenging. It requires immense effort just to understand and cater to all those diverse needs.
Sure.
But a major internal hurdle is often outdated legacy systems and data silos. Many retailers have systems built up over decades that just don't talk to each other.
Right, the old tech problem.
Exactly. It means it can take days to collect and analyze data that could inform quick decisions. This tech debt, it's expensive and time-consuming to address.
But necessary.
absolutely essential because data quality is paramount for these AI tools to work effectively. Whether it's for forecasting, inventory management, personalization, without good, clean, accessible data, the AI is basically useless.
So legacy technology is a real constraint on their ability to adapt quickly. Okay, let's shift gears a bit from those operational challenges to the retail landscape itself. That ongoing evolution of where and how people shop. The interplay between physical stores and e-commerce. Navidar's report you mentioned paints a compelling picture of the e-commerce world.
Yeah, they really underscore that e-commerce isn't just some side channel anymore. It's a massive, dynamic market segment. They estimated it hit, $1.2 trillion in sales in 2024?
Trillion.
Yeah. And this is just a continuation of that fundamental long-term shift in consumer behavior, from shopping exclusively offline to increasingly shopping online.
And within that huge number, mobile commerce shopping on phones, that's a huge piece, right?
It's enormous and growing incredibly rapidly. M-commerce, they reckon, accounted for $568 billion in sales in 2024. That's 48% of all U.S. e-commerce sales.
Almost half.
Almost half. And as a share of total retail sales, commerce reached 7.7% in 2024. The growth rate is just staggering, a 20% compound annual growth rate CAGR since 2018.
Wow, 20% average growth per year.
Yeah, and that's resulted in a 120% increase in its share of total retail in just 6 years. Went from 3.5% to 7.7%.
That kind of growth fundamentally changes the market structure.
Yeah.
What are the main drivers behind this relentless e-commerce expansion? What's pushing it?
Well, the foundation is just high mobile and overall online adoption rates. Most people are connected and comfortable online now.
Sure.
Then there's the sheer breadth of products available online across countless categories, countless retailers.
Endless aisle, basically.
Pretty much. But fundamentally, e-commerce offers these meaningful advantages over offline retail that really resonate with consumers. And these advantages are constantly being enhanced by new tech.
How does e-commerce growth compare to traditional brick-and-mortar retail growth these days?
Oh, e-commerce is growing significantly faster. Navidar estimates online sales are expected to grow around 10% annually, while offline retail is projected more, around 3%. If that trend continues, e-commerce could become a $3 trillion market, representing a little 31% of total U.S. retail sales within the next 10 years.
31%. That's a massive shift in market share.
It really is.
So what are those specific compelling advantages that Navidar highlights, the ones driving consumers to shop online?
Well, the biggest one, hands down, is convenience.
Always comes back to convenience.
It really does. It saves time, it saves hassle. No driving, no parking, no navigating crowded aisles, no waiting in long lines.
Right.
You can shop anytime, anywhere, from your couch, on your commute. The control is entirely in the consumer's hands. Plus, you've got helpful tools instantly available, customer reviews, product videos, easy search.
Yeah.
And Deloitte's data backs this up too. They showed retailers who focused on convenience drove something like 67% of total market growth between 2016 and 2019.
Wow. Okay. Convenience is king. What about finding the best price and having choices? How big a factor is that online?
Huge. Price discovery and selection are massive online advantages. Consumers are actively seeking savings, and e-commerce makes it incredibly efficient to compare prices across different retailers.
Like checking multiple sites in seconds.
Exactly. One source noted that 72% of consumers check prices and reviews on Amazon before making a purchase anywhere else.
72%. That really shows Amazon's dominance in just setting the benchmark for price comparison.
It really does. And it highlights consumer price sensitivity. 57% of consumers say the lowest price is the most important factor in where they ultimately decide to buy.
Over half.
Yeah. And e-commerce also provides access to just the widest variety of products imaginable. Makes it easy to find niche stuff, hard to find items, instantly check stock levels, all aided by those readily available reviews, ratings, videos.
And this price sensitivity, does it extend to private labels online?
Very much so. 76% of Amazon shoppers, for example, are more likely to buy a private label product, and 75% believe the quality is similar to or even better than name brands.
Interesting. And that's good for retailers too, right? Margins on private labels.
Generally, yes. Private labels often offer higher margins for the retailer, typically around 25–30%.
Navidar mentioned companies like Warby Parker, Readers.com, examples of businesses leveraging these online advantages, right? Selection, value.
Exactly. They built their entire models around the efficiency and reach of e-commerce to disrupt traditional markets. Another advantage Navidar highlights is instant gratification.
The impulse buy.
Yeah. E-commerce platforms are very, very good at leveraging our human tendency for impulse purchases. One survey found 73% of respondents reported their online purchases tend to be spontaneous. That ease of buying with just a click really facilitates it.
So convenience, price, selection, even triggering impulse buys.
Yeah.
Powerful online drivers. What technologies are specifically enhancing the e-commerce experience right now?
Well, the mobile phone is just foundational. It completely changed how and where people shop. It allows shopping anywhere, anytime, even inside a competitor's store. Get this, 65% of shoppers use their phone in-store to price compare elsewhere.
Wow. Showrooming is alive and well.
Oh, yeah. And QR code usage is growing too. 56% have used them to quickly access product details, promotions, that kind of thing.
How are retailers optimizing their online presence specifically for these mobile users then?
Well, they're adopting mobile-first design principles because so much shopping happens on phones now. 48% of online shopping is on mobile.
Makes sense.
They're also developing dedicated mobile apps for a smoother experience, optimizing their sites for voice search, which is expected to account for, 50% of all searches soon.
50% via voice.
Yeah, and integrating digital wallets, mobile payment options for fast, seamless checkouts. It's all about reducing friction on mobile.
Mobile is clearly central. What about social media's role? How is that playing into reaching customers and driving sales?
Oh, it's huge. Online entertainment, social platforms, they provide access to absolutely massive, engaged consumer pools, and social commerce, where purchases happen directly within or via social networks, that's growing significantly. 30% of online purchasers report buying via social networks.
So people are discovering products there.
Absolutely.
Yeah.
Discovering products, discovering brands through content recommendations.
And influencers are a big part of that discovery, I assume?
A very big part.
Yeah.
Influencer marketing is a growing industry, attracting significant ad spend, increasing reach. 37% of consumers say they've bought something after seeing Amazon influencers.
Interesting.
Consumers also use things like live streams, unboxing videos to get a sense of products they can't physically touch. And here's a striking stat. 9 out of 10 people are willing to buy from brands they follow on social media.
9 out of 10. That's incredible engagement.
It is. And the concept of shoppable media is expanding beyond just traditional social networks, too. Deloitte gave the example of Netflix partnering with Google Lens,
Oh, yeah.
allowing viewers to use their phone to identify and then shop for items they see in shows.
That integration of content and commerce is fascinating. Does this kind of social commerce help retailers lower the cost of acquiring new customers?
Yeah.
Compared to traditional ads?
Potentially, yes. Social commerce provides this direct access to highly engaged customer pools who are often already interested in the brand or the product category.
Right. They're opted in a way.
Exactly. So that direct connection, the influence of creators, it can lead to lower customer acquisition costs and potentially higher conversion rates too, because the customer is already in that discovery mindset.
Okay, so e-commerce.
Yeah.
Undeniably powerful, driven by convenience, value, technology. But what about the physical store? The sources make it clear it's definitely not disappearing.
That's the crucial counterpoint, isn't it? Despite all the headlines about the big shift online, Deloitte reminds us that a substantial majority, 80% of shopping, still happens in a physical store.
80%. That's still huge.
It is. And MarketSource points out that shopping center vacancy rates are actually at a 2-decade low of 5.4%.
A low. Interesting.
Yeah. It suggests the physical footprint is resilient, but its role is fundamentally evolving.
How is the role of the physical store changing in this landscape then?
It's becoming less about just being a place to transact, and more about providing an experience and complementing the digital channels. More than a third of retail execs see enhancing the in-store experience as a top growth opportunity, according to Deloitte.
Okay, experience is key.
And while foot traffic hasn't fully returned to pre-pandemic peaks, it is recovering, currently sitting at about 81% of pre-pandemic levels, according to MarketSource.
And consumer expectations in the store. They're different now, too, influenced by online.
Absolutely. Shoppers who are used to the convenience and personalization of online, they expect a similarly effortless, flexible, integrated experience when they walk into a physical store.
Makes sense.
They still expect convenience, personalization, access to loyalty benefits, selection, but they want it delivered seamlessly, reflecting that digital-first mindset they have now. And MarketSource found that the vast majority, 83%, report having positive experiences in-store. So retailers are clearly doing some things right.
Okay, so what specific efforts are retailers making to enhance that physical store experience.
Yeah.
To meet these new expectations.
Well, they're leveling up services. Things like offering proactive appointment scheduling for personal shopping, consultations, things like that. Creating space for live events within the store. 35% of retail leaders plan more of those. Integrating tech like augmented reality, AR for virtual try-ons or maybe stylist services. Some are offering exclusive content or product drops only available in store, to drive foot traffic.
So technology isn't just for online, it's really moving into the store environment too.
Oh, definitely. Data-driven store design and layout are becoming more common. Using analytics to understand traffic flow, product placement.
Optimizing the space.
Exactly. Immersive experiences using touchscreens, maybe VR, AR, they're being tested to make browsing more engaging. Market Source found nearly half of shoppers, 47%, feel positive about seeing digital screens used in places like grocery stores, maybe providing info or recommendations.
What about operational improvements in store? Thinking about convenience, but also profitability. Theft is a big issue, right?
Huge issue. Retail theft prevention is a major focus. 3/4 of executives are planning increased investment there.
Okay.
But technology is also helping with convenience and making more products accessible on the floor.
Yeah.
The cost of RFID tags, those little electronic tags for tracking inventory, has become much more affordable.
Oh, right.
So retailers can tag more individual items now. This helps with real-time inventory accuracy, but it also means more merchandise can be kept out on the shelves rather than being locked away behind glass, which improves the shopping experience.
That's a good point. And are retailers investing in their actual physical footprint? Building new stores, remodeling?
Yes. Nearly half of executives plan moderate to significant investments in remodels or new store locations in 2025.
But strategically, presumably.
Very strategically, focusing on convenient locations, developing smaller format stores, especially for urban areas or specific categories, and creating destination stores.
What's a destination store?
Think flagships that offer unique experiences, not just products. Maybe they have cafes, workshops, interactive exhibits, reasons to go beyond just buying something.
Okay. This all clearly points to the lines between online and physical just blurring completely. It sounds like omnichannel isn't just a nice-to-have anymore, it's table stakes.
It absolutely is. Market Source and Deloitte both really hammer this point home. Omnichannel shoppers, the ones who use both physical and digital channels, they're significantly more valuable to retailers.
How much more valuable?
According to Deloitte, they spend 1.5 times more than customers who shop using only one channel.
Wow, 1.5 times.
Yeah. The big challenge for retailers, though, is making the seamless integration profitable. Because managing multiple touchpoints, often using third-party vendors for things like last-mile delivery, it adds complexity and cost.
So what's the key to a successful omni-channel approach from the consumer's perspective? What do they want?
Seamless communication and a smooth customer journey across all channels. 61% of global shoppers specifically want their data, their preferences to follow them. From online browsing to the in-store experience and back again.
Can you give an example?
Sure. Like a customer checking real-time inventory for a specific size and color at their nearest store using the retailer's app. Or maybe using a digital kiosk in-store to connect via video with a remote expert who can give them more product info or advice.
Got it.
It's all about ensuring every touch point feels connected and contributes to a single positive overall experience.
So the most successful retailers won't be just great online or great in-store. They'll be great at connecting the two seamlessly. Okay, let's move now to the underlying operational shifts and the technology driving retailers' ability to actually operate in this complex environment. Deloitte talks about the pressure to master efficiency and this move from mass to micro. What does that transformation entail?
It's really a fundamental rethinking of how retail operates. Historically, retailers focused on efficiently matching goods for the broad masses of consumers.
Like one size fits many.
Exactly. Now, driven by data and the need for personalization, the focus is shifting to delivering highly tailored micro experiences for individual consumers. It's about understanding and serving individual needs, but doing it at scale.
And why is finding efficiency so critical right now? What's the pressure?
Well, retailers are under immense pressure to just do more with less. You've got rising costs, supply chain complexities, intense competition. Cost reduction is a top priority. The second most cited goal for executives in 2025. And this urgency is amplified by that burden of legacy systems we talked about earlier, that tech debt.
Right, the old system's holding them back.
Yeah. Many retailers are operating on outdated tech infrastructure that's expensive to maintain, difficult to integrate with new tools, slow to adapt. This debt is a major headwind against making those quick, necessary transformations.
So despite the high cost and difficulty, embracing technological transformation is basically essential for survival.
Absolutely. The retailers who are succeeding are making significant investments in technology upgrades, specifically to deepen customer relationships, improve their omni-channel capabilities, and empower their employees with real-time, data-driven insights. Foot Locker was mentioned as an example of a retailer making these kinds of strategic tech investments.
How does technology, especially AI, help improve efficiency at the employee level, in the store or warehouse?
Well, AI tools can streamline tasks for store associates, warehouse workers, maybe guiding them through processes, instantly answering operational questions.
Reduces training time.
Exactly. Reduces training needs, frees up employees to spend less time on administrative stuff, and more time on what's most valuable, actually engaging with customers. Deloitte highlighted a grocer who used an AI-powered task management platform.
Yeah?
And it resulted in over 80% of their stores increasing task completion rates and seeing double-digit productivity gains.
Wow, that's a tangible impact.
Deleted.
Are retailers looking at external partnerships to help with this transformation and efficiency drive? Outsourcing?
Yes, and there's a shift happening in how they use outsourcing and partnerships. Instead of just transactional relationships, they're forming more strategic partnerships. To improve core capabilities they might struggle with internally, like complex space management or omni-channel fulfillment logistics, or critical areas like data privacy and cybersecurity.
And helps with talent too, presumably.
Yes, it allows them to offload the need to hire and retain expensive, highly specialized talent in those specific areas.
Supply chain optimization is another area where efficiency is crucial, especially with all the potential disruptions we still hear about.
It remains a critical focus, absolutely. 3 in 10 executives are specifically investing in technology to modernize their supply chains. AI-enabled forecasting is a key tool here.
Helping predict demand better.
Yeah, predict demand more accurately, manage inventory across their whole network. Lamps Plus, for example, uses AI for omnichannel forecasting. But despite these tech investments, challenges persist. Dealing with fragmented consumer demand, fluctuating volumes, ongoing global supply chain issues, increased transportation costs. It's still tough.
Beyond just operational efficiency, how are retailers approaching strategic growth in this environment? Deloitte mentions M&A mergers and acquisitions. Is that picking up?
Yeah, M&A is being used not just for traditional scaling, like getting bigger, but strategically. To achieve specific goals in this evolving market, retailers are looking to acquire diversified revenue streams and, importantly, to accelerate their progress towards the mass-to-micro goal we talked about.
How does M&A help with the mass-to-micro transition specifically?
By acquiring companies that bring specific capabilities or maybe new customer segments. The top acquisition targets for retailers right now. Tech players, 40% of execs cited that, followed by brands, 31%, logistics companies, 29%, and digitally native players, 28%.
So buying tech brings analytics, buying a brand brings customers.
Exactly. Acquiring a tech company might bring personalization or data analytics capabilities instantly. Buying a digitally native brand brings access to a new customer base, e-commerce expertise. Acquiring logistics capabilities strengthens their omni-channel fulfillment.
Any real-world examples of this kind of strategic M&A?
Yeah, a notable one is Walmart purchasing Vizio, the TV and advertising platform.
Right, I remember that.
So that allows a mass merchant like Walmart to gather more granular consumer data directly from households, tailor advertising much more precisely, and generate entirely new revenue streams from ad sales, moving beyond just selling physical goods.
That's a big shift.
Another example given was a large farm and garden supply chain company buying an online pet pharmacy. That significantly expanded their addressable market by like $15 billion and added a whole new category. It's about finding new points in the customer life cycle, new revenue streams that complement their core business.
That really shows a willingness to think outside the traditional retail box. Okay, we've mentioned AI so many times, it feels like the thread connecting everything. Let's focus specifically on its pervasive influence across the retail sector. Is it still mostly hype, or are we seeing concrete results now?
According to Deloitte, NRF, Navidar, all the sources really, AI is definitely moving beyond the hype phase. It's delivering tangible successes. For instance, retailers using AI-powered chatbots during Black Friday weekend, they reported a 15% better conversion rate compared to those who didn't.
15%. That's a clear impact on the bottom line.
Definitely.
Where else is AI proving its worth in retail?
Well, improving demand forecasting and inventory management is a major area. 6 in 10 retail buyers saw improvements there thanks to AI-enabled tools in 2024.
Getting inventory right. That's fundamental.
It's fundamental to profitability. Having enough stock without being overstocked, it's a complex puzzle, and AI is really helping solve it.
And back to personalization, which we keep touching on. How critical is AI there?
It's foundational for achieving true hyper-personalization. 7 in 10 retail execs expect to have AI capabilities for personalizing customer experiences within the year.
Okay.
Generative AI, in particular, is enabling the creation of dynamic, highly personalized content on the fly. Think personalized product recommendations, tailored marketing messages, powering more sophisticated, real-time virtual assistants and chatbots that can interact much more like a human.
And predicting needs, too.
Yeah, its predictive capabilities allow retailers to anticipate what a shopper might want or need, maybe even before they explicitly search for it.
It really does seem like AI can touch almost every aspect of the retail business.
It truly can. Beyond the customer-facing stuff, it's streamlining back-end operations, too. Optimizing store layouts, accelerating product design by analyzing trends and preferences, automating customer service tasks, call centers, making those chatbots much more intelligent and capable.
With all this amazing potential, what are the obstacles, the concerns retailers and consumers have about this rapid adoption of AI? The NRF mentioned some.
Yeah, one major obstacle is still integration. Fitting these new AI tools into those existing legacy systems we discussed, it's complex, it's costly.
Right.
There are also significant concerns around data privacy. Ensuring customer data used to train and power AI is handled responsibly, securely. That's huge. The NRF notes that the initial easy wins with AI, like simple chatbots, might be over. Further progress means tackling these deeper integration and data challenges.
And is there concern about trust, security?
Absolutely. For consumers to accept these AI-driven experiences, transparency and ethical data use are paramount. Retailers need to be really clear about how AI is being used, and cybersecurity experts, they're increasingly focused on securing the AI applications themselves as they become so central to sensitive operations.
Speaking of complexity and trust, let's touch on marketing challenges in this fragmented world. The NRF highlights that it's just getting tougher for retailers to capture attention to connect.
It really is. Retailers need to constantly, as they put it, hone their marketing mojo, because a one-size-fits-all approach, it just doesn't work anymore. Each generation requires a distinct, nuanced approach.
How do the approaches need to differ by generation? What are the key differences?
Well, for Gen Z, authenticity and social responsibility are crucial. They want to buy from brands whose values align with their own ethics.
Okay.
Millennials prioritize experiences and personalization, and they expect brands to engage with them seamlessly across multiple platforms. Gen X tends to value convenience and efficiency. They want hassle-free, straightforward interactions.
Like baby boomers.
Baby boomers look for clarity, trust, reliability, and they really value strong customer service. So messaging that resonates with one group might completely miss or even alienate another.
That's a huge challenge, tailoring messages across such diverse expectations. What other factors make marketing so complex right now?
Well, there's a growing mistrust in advertising generally, partly due to just overexposure, partly privacy jitters.
Right.
The customer journey itself has become incredibly complex, non-linear. People don't typically follow a straight path from seeing an ad to buying something anymore.
It's all over the place.
Exactly. Figuring out the key touch points that actually influence a purchase is much harder now, and it varies hugely depending on the product, the individual. Plus, there's just product saturation everywhere. Shoppers are often overwhelmed with choices, taking longer to evaluate options because so many products are competing for their attention online and in-store.
That sounds like a really tough environment for marketers trying to break through all that noise. Let's briefly revisit supply chain resilience. The NRF flagged that as still being important.
Yeah, the goals for 2025 supply chains are clear. They need to be adaptable, efficient, resilient. There are still significant external risks out there, like the potential for a strike at East Coast ports or ongoing uncertainty around tariffs with key partners like China, Mexico.
But are retailers better prepared now than, say, during the peak pandemic disruptions?
Generally, yes, largely through technology. They're using AI and machine learning, not just for basic inventory tracking, but to build predictive capabilities into their supply chains.
How does that help?
It helps them anticipate potential disruptions, whether it's a port issue, a sudden change in demand, a raw material shortage, and adapt before it becomes a full-blown crisis. being more proactive.
Are there specific technologies to watch in the supply chain space? Things that are gaining traction?
Trends to keep an eye on include the increasing use of robotics and automation in warehouses, distribution centers to improve speed and efficiency, and enhanced tracking technologies like blockchain, which can provide greater transparency and traceability throughout the whole supply chain.
All right, that gives us a really comprehensive picture of the core dynamics. The economy, consumer behavior, the channel evolution, operational challenges, and that driving force of technology, especially AI. Let's wrap up by looking at a couple of key emerging trends that are influencing retail, starting with health and wellness.
Yeah, the NRF points out that health and wellness continues to be a major priority for U.S. consumers. It's not a passing fad. It's a large and growing market segment estimated at $480 billion in the U.S. alone.
Wow, $480 billion.
And expanding at a healthy clip, around 10% yearly.
And where are consumers focusing their spending within health and wellness these days? What's trending?
There's a clear shift towards more science-backed products and services. Consumers are increasingly investing in things like at-home diagnostic tests to understand their own health data better. Wearable technology like biometric rings or continuous glucose monitors paired with sophisticated apps. And there's also an amplifying dialogue and increased spending around specific areas like menopause products, preventive medicine aimed at healthy longevity.
Wow.
And of course, the impact of new weight loss drugs like GLP-1s. Those are used for managing blood sugar, but have significant weight loss effects, and they're influencing demand for related products and services too.
That suggests retailers in this space really need to emphasize credibility, scientific backing to resonate with consumers. Okay, finally, let's discuss a trend that has seen absolutely explosive growth and has significant implications for both retailers and consumer finance. Buy now, pay later, BNPL. The Richmond Fed recently published an economic brief digging into this.
Yeah, this is a really critical trend to understand because BNPL has, well, incredibly quickly become a significant and highly popular form of consumer payment.
So what is it exactly at its core?
At its core, it's a type of short-term financing. Consumers can purchase goods or services and pay for them in interest-free installments. Most commonly, it's structured as a pay-in-4, model for equal payments, typically spread over 6 weeks.
And how rapid has the growth actually been? Do we have numbers?
The growth has been truly explosive. The Richmond Fed brief cited data showing the number of BNPL loans originated by just the top 5 lenders in the U.S. It surged from 16.8 million in 2019 to 180 million in 2021.
Whoa. That's more than tenfold in 2 years.
Incredible growth. And the total value of these loans jumped from $2 billion to $24.2 billion in that same short period.
Billion with a B.
Yeah. Now, that data is a little older, but a New York Fed survey in October 2023 found 20% of consumers surveyed reported having used BNPL. 1 in 5.
1 in 5 adults.
And based on growth reported by just one major provider, the total issuance by the top 5 lenders could be estimated around $36.3 billion in 2024. The market size is still expanding rapidly.
Who are the main companies offering these BNPL services? Are they banks?
No, they're primarily fintech firms. The companies focused on financial technology. You know, names like PayPal, Afterpay, Affirm, Klarna, Zip, Cecil. Those are the big players.
And how do these companies make money if the loans are interest-free?
Well, their primary revenue stream comes from fees charged to the merchants, the retailers who choose to offer BNPL as a payment option at checkout.
The merchant pays?
Mostly, yes. They also generate some revenue from late fees charged to consumers who miss their installment payments.
Why are merchants willing to pay these fees? Are they higher than credit card fees?
Often, yes, they can be higher than the interchange fees charged by credit card companies. Merchants are willing to pay because they see clear benefits. Surveys, retailer data, it all shows that offering BNPL can increase overall sales volume, improve conversion rates, turning browsers into actual buyers, and increase the average order value, the ticket size.
So people buy more and more often.
Yeah. That's the idea. From an economic perspective, you could see it as a form of price discrimination. It allows merchants to offer a kind of interest-free subsidy to consumers who are maybe more price-sensitive or perhaps don't have sufficient credit or funds readily available to make the purchase otherwise. It expands their potential customer base.
Are there any potential downsides for the merchants who adopt BNPL?
Potentially, yeah. If a merchant promotes BNPL heavily, They might end up shifting existing customers who would have just paid with a less expensive method like a debit card over to the more costly BNPL option.
Cannibalizing their own sales, in a way.
Could be. And if the increased costs from those BNPL fees eventually outweigh the benefits from incremental sales, well, theoretically, it could lead to higher prices for all consumers down the line. Plus, once BNPL is widely adopted and customers expect it, it can be really difficult for merchants to stop offering it without risking losing sales.
Right, it becomes the norm. Now, let's flip it. Look at it from the consumer's perspective. Who is typically using BNPL? And what are the potential risks to them?
Research indicates that consumers who use BNPL tend to have riskier credit profiles compared to the general population.
Meaning?
They're often younger, maybe have lower levels of education, higher existing debt burdens, lower credit scores. The Richmond Fed brief specifically notes BNPL is disproportionately used by lower income groups and those with lower credit scores.
Okay. Does using BNPL impact their overall spending or financial health?
Studies suggest that access to BNPL does increase consumers' total spending levels and also the proportion of their spending allocated to retail purchases.
Makes sense. It feels cheaper up front.
Right. By breaking down payments, it can reduce consumers' price sensitivity on the items they buy using BNPL. However, this can also increase the likelihood that consumers face negative financial outcomes, especially if they have low liquidity, not much cash on hand, and maybe take on multiple BNPL loans or struggle to manage the repayment schedule.
The Consumer Financial Protection Bureau, the CFPB, they have specifically identified risks for consumers using BNPL, haven't they?
Yes, the CFPB has definitely raised concerns. They point to inconsistent consumer protections compared to traditional credit cards, like maybe a lack of standardized cost disclosures up front, or minimal formal dispute resolution rights if there's a problem with the purchase. There are also concerns about how BNPL providers harvest and potentially monetize consumer data, and critically, the risk of debt accumulation and overextension. Consumers taking on multiple BNPL loans simultaneously, maybe borrowing more than they can realistically afford to repay across all their different obligations.
So what has the regulatory response been to these concerns? Has anything changed?
Yes, the CFPB has taken significant action. Just recently, in May 2024, they issued a ruling classifying BNPL lenders as credit card providers under the Truth in Lending Act.
Okay, that sounds important. What does it mean in practice?
It's a major step. It means BNPL providers are now required to investigate disputes raised by consumers, provide refunds or credits for returns or cancellations, and furnish billing statements, basically bringing them much more in line with the consumer protections offered by traditional credit cards.
This regulatory action seems to tie into a broader financial stability concern the brief discussed, something they called phantom debt. What exactly does that mean?
Phantom debt refers to the fact that because most BNPL loans are not reported to the major credit bureaus, they're essentially invisible to other lenders.
So when you apply for a mortgage?
Exactly. When a consumer applies for a mortgage, a car loan, even a traditional credit card, the lender doesn't see the full picture of the borrower's existing BNPL obligations. This hidden debt can lead to consumers being overextended, taking on more total debt across BNPL, credit cards, other loans than they can actually manage to repay.
Which increases default risk.
Increases the risk of default, yeah. Not just on the BNPL loan, but potentially on other debts as well.
How do the reported BNPL delinquency rates compare to other types of consumer debt then? Are people defaulting more?
Well, reported delinquency rates specifically on BNPL loans appear relatively low so far. The Financial Technology Association reported rates below 2%.
That sounds pretty good compared to credit cards.
Yeah, it's lower than overall consumer debt delinquency, which is around 3.5%, and significantly lower than credit card delinquency, which was near 8.8% in Q3 2024. However,
there's a catch.
There's a potential catch. The brief argues this is likely a lower bound measure because of something called spillover effects.
Spillover effects. Can you explain that? What does that mean?
It means that using BNPL might negatively impact a consumer's ability to pay other debts, even if they manage to keep up with their BNPL payments themselves.
How?
For example, many BNPL loans use autopay, pulling directly from a consumer's bank account. While this helps ensure the BNPL payment gets made, it reduces the consumer's available bank balance, which might make it harder to pay other bills or could lead to increased reliance on credit cards for everyday expenses, pushing up credit card debt. Also, some borrowers might prioritize making those smaller, frequent BNPL payments, maybe to maintain access to the service, or increase their spending limits, potentially causing them to miss or delay payments on larger, more critical debts like car loans, mortgages, or student loans.
So the delinquency isn't showing up on the BNPL loan itself, but it's potentially causing delinquency on other credit products.
Exactly, that's the crucial distinction. The risk might be hidden because it's impacting other parts of their financial life.
So what's the overall impact on broader financial stability right now? Is this a systemic risk yet?
The brief suggests that currently the overall impact on the broader financial system is likely limited.
Why is that?
Primarily because the BNPL market size, while growing incredibly rapidly, is still relatively small compared to the total amount of U.S. household debt, which stood at, $17.9 trillion total, including $1.2 trillion in credit card debt as of Q3 2024.
Okay, so it's still a small piece of a very large pie. But if its rapid growth continues,
Exactly. That's the key point. Its future growth needs careful monitoring. Because BNPL services often have lower lending standards, and the loans aren't typically reported to credit bureaus. They can serve as an entry point for risk and debt accumulation, particularly for more vulnerable consumer groups.
so the conclusion is more monitoring needed.
Yeah, the brief concludes that policymakers, the BNPL industry itself, they need to collaborate on ensuring effective oversight, promoting responsible lending practices, enhancing consumer protections as the market continues to expand, to mitigate potential future risks, both to individual consumers and potentially to broader financial stability down the road.
It's clear that BNPL is a trend that, offers significant convenience, definitely drives retail sales, but it also introduces these complex new dynamics and potential risks that need really careful attention as it becomes more and more integrated into how we pay for things.
A definite area to watch closely right at that intersection of retail and finance.
Absolutely. Well, this has been a fascinating, really deep dive into the forces shaping U.S. retail right now. We've seen such a complex picture, an economy that's generally supportive but, vulnerable to shocks like tariffs, a consumer who's juggling optimism with caution, constantly seeking value in all sorts of different ways, actively shifting where and how they spend.
Right. That constant rebalancing act.
Yeah. We've explored the evolving landscape where e-commerce is dominant, but physical stores are fighting back, offering enhanced experiences, and how technology, especially AI, is just absolutely critical for retailers trying to understand and serve this fragmented, value-seeking consumer.
The tech piece is unavoidable now.
Totally. And we've delved into the rise of new financial tools like BNPL, which offer convenience, but introduce these new wrinkles in consumer debt and potential financial stability concerns.
I think the message coming through is clear. Retailers just cannot afford to stand still. Success really hinges on rapid adaptation, moving toward those personalized, efficient mass-to-micro strategies we talked about. Integrating their physical and digital channels into a seamless, effortless customer journey, that's no longer optional. It's essential for capturing the most valuable shoppers. And fundamentally, building and maintaining trust, whether that's through transparent data practices, ethical AI use, or responsible financial product offerings like BNPL, that's paramount in such a crowded and complex market.
So the key takeaway, really distilling it down from all these sources, is that the future of retail is far more nuanced than just selling products online or in a store. It's really about delivering tailored value, convenience, and genuinely engaging experiences across a landscape that's just constantly evolving.
Well said.
It requires a deep understanding of increasingly diverse consumers and the ability to leverage data and technology ethically, efficiently to meet their needs.
Exactly. And perhaps a final provocative thought for you, the listener, to ponder as you watch the retail sector unfold. Given the growing use of the NPL, particularly by younger and lower income consumers, and the fact that these loans aren't always fully visible to other lenders, what does this hidden phantom debt really mean for overall consumer financial health and stability if BNPL continues on its current rapid growth trajectory? It's a question that reaches beyond just the act of buying something, isn't it? It touches on the broader financial ecosystem.
That's a powerful point to leave it on. Definitely something worth thinking about as we see how this all plays out. Thanks so much for guiding us through this complex but absolutely critical sector in our deep dive today.